Hey traders, Raghi here, and in today's recap video, we're going to dive into the dollar yen. Now, we've been pretty busy with currencies this week, and it's not a function of just randomly choosing one asset class over the other, but it's really a function of looking at what's moving and preferably what is trending. And there's not a lot that's really trending in the equities markets. There are a lot of distribution market trends, a lot of chop. But when you take a look at especially the yen has been a very strong currency. And to buy yen against the likes of the Australian dollar, against the likes of the Canadian dollar, and also, yes, the US dollar, which I imagine most traders are familiar and perhaps even comfortable with, is what I want to focus on here today. Now, our spreadsheet has had the dollar yen on it since yesterday. We're looking for a daily time frame short trend off the 106.45 level. So we've got this fill, and we're using a 107.35 stop, and we're looking for a 105.60 target. Now, this is a trade right from our spreadsheet, but let's talk about the trend and why it makes a little bit more sense to be more conservative, if possible, when I'm lacking propulsion dots. Now, notice we don't have a consistent string of the red dots, which means the 21 EMA really ideally is not where we want to situate ourselves. We want to wait for something more along the lines of the 34 on the low, which is the red moving average. But if you're looking at this market for the first time, say yesterday or even today, so there's a big difference between looking at a trade back in these red grab candles or finding this market yesterday or today. Your entry is going to be different because the colors of the candles are different. So going into yesterday, if you had this market on your radar, you took that 106.45 short, which is fine. But if you're looking at it today, you're actually looking at the middle line of the wave up near 106.75. Now, they're both valid. There's only 30 pips between those two entries. But the reason we would go with the 34 EMA on the close, or the blue line, this blue moving average, is because once the candles do go blue, go to the blue, because you want to be more conservative about your entry. You don't want to short something aggressive. In other words, you want a taller bounce to short into because the overall trend is not as organized. And if you use that one tip right there, find the trends, find the dots, and if things go blue and or lose dots, simply focus on more conservative entries. You are simultaneously increasing your potential reward, reducing your risk, and treating the market the way you need to, which is saying to a market that is still trending, but not with the same velocity, not with the same acceleration, which we measure with the propulsion dots, and saying, yeah, I'll short you, but you've got to correct to a higher level in order for me to have a decent risk reward. And that is a tip that's very easy to use. It's one of the simplest use of the grab candles, which stands for green, red, and blue. Try them out. They work on many systems. They're complementary to any approach. And I think you're going to find that you're going to see a marked difference in your market trend recognition, identification, and your entries as well, because you'll have a much clearer picture of the quality of the trend and the direction of the momentum and the sentiment. See you in the next update.